In yesterday's video, there was some problem with my trading view. So I was not able to discuss that breakout. So have a look at this. We looked at the base till this candle. Then the breakout candle comes, which is actually a fake out. So this is high volume, weak closing. So high volume and the candle closes weak. So in such cases, if you buy the stock here, then you would have to lighten up on your position size, maybe sell half. But notice it did not hit the 8% stop loss. So let's say you took 10% position size here. By the time the stock closes down, you would sell 5%. You will sell half of your shares. You will keep the remaining half with the 8% stop loss. And then one, two, three, four. In three candles, it reaches the selling zone. So it shoots up like 20-25% in just 3 days. Okay, that's the power of the base. The base was weak. That is why you see volatility like this. That is why you will have to book the loss on that 50% shares. Let's say you bought 100 shares on this breakout, which is actually a fake out day. Okay, because the stock went up, then heavy supply came from institutions, stock went down. So in Mark Minervini's book, that is called as a squat candle. I have made a separate video on what exactly is a squat candle. You can have a look at that. I don't know when I made the video. It was old video. But anyways, squat doesn't mean that the base has lost its relevance or the base has reset or anything like that. Squat simply means that the risk in that position has gone up. So you have to either move your stop loss up or you have to lighten up on your position size. Okay. Uh, so that would be my position. I still remember I bought this stock. Okay. Yes, I think I bought on this day, maybe sold half and then exited at 20-25%. Okay. So that's yesterday's uh, breakout analysis. The stock did reach the target selling zone. Some stocks take 1 month, some stocks take 3 months. Some stocks within 3 days, 10 days, they reach the target. We don't have any control over that. What we have control over is the quality, the analysis of the base. If you notice, the base was not very high quality. Majority of the candles are in the red zone. Still, it reaches the target, right? So you never know. All we have to do when we are doing base quality analysis is that we have to assess what is the risk and then decide whether we want to buy the stock and what position size. It is not a question of yes or no, should I buy or should I not buy. The question is how much is the risk? Depending on the risk, I will decide my position size. If the risk is too much, the position size will be zero, which means I will not buy the stock, right? Most students think of basis as whether I should buy or not buy. For them, it's a binary decision. For me, it is not a binary decision. I could buy any base. Even if the base is D grade base, I could still buy the base. But what about the position size? Well, that depends on a lot of factors which are written here. Okay. The position size will depend on whether the market condition is uptrend or rally attempt or uptrend under pressure, whatever. The position size will also depend on whether it's a positional trade or not, or whether it's a swing trade. It will also depend on the fundamental characteristics of the company. It will also depend on the wave heights. Okay, a lot of factors come into play. That is why I am spending time on the base quality analysis for you. So in this video, we will look at another company, which is Ratan India. I remember buying this base, Ratan India. Yes, I had bought this stock. So that's the base. Now in this video, I have not filled this up. I will fill this up in front of you. So let's first draw the base. Hope today trading view works. Okay, now have a look at this. Straight away, you come to know that this is a deep base, low quality base, and no green zone closing. Look at the height of the green zone. It's too much risk. Look at the 50-day simple moving average stopping down. So quick, without even looking at all this, you can quickly make an assessment now that wait, there is a problem here. What are the positives in this base without even looking at these points? Well, you see tightness developing on the right side. Very good aspect. Okay. High of this candle is 6410. This is 6405, which means there are 6 points in the base. So let's start our normal drill. Price is above the all the three moving averages. Yes. Within 52-week high from the top, let's see from here till closing, it's 10% fine. Is that the 52-week high? Yes. So this is November 2023. Let's go to November 2022. Where is November? This is November 2022. So that's the 52-week high. Okay. Then candles, number of candles in the base. I'll have to update that from here. 50 bars. Okay. So let's change this. What happened here? Then, yeah, points, number of points. There are 6 points in the base. 0.1, 0.2, 0.3. Then this is 0.4, 0.5, 0.6. Okay. 6 points in the base. So the high of this candle, which is 64.05, becomes our buy point. 64.05. Okay, let's draw the remaining lines as well quickly. So from here, let's go to 1% up. Then let's go 20% up. Then let's go 25% up. That's the selling range. Then let's go 8% down. That's the stop loss. Okay. We'll change the color. This is red color. That's the stop loss. Then the selling range, let's make it green color. So 20 to 25% selling range from the yellow line. The buying range is the yellow band. Red color is the stop loss. Okay. Very, very simple. Nothing complicated here. This is not rocket science. Number of points in the base, 6. Okay. Falling window, there's no falling window in this base. There is a falling window, but it is closed. Buy point in green zone, fantastic. Closing price in blue zone. Okay. Mother baby candle, obviously there is a mother baby candle here. Look at these two candles. Okay. There are more mother baby candles here. See these two candles. That's a mother baby candle. Even this candle, that's a mother baby candle. So latest 5-6 candles, if you see, 3 mother baby candle combinations. Very, very good, powerful, tight price action. Okay. Favorable candles 50%. I think so. Let's not count. Let's look at this visually. Okay. Most of the price action, most of the price action is low volume. Most of the bars are red bars. What are we looking for? We are looking for red bars on low volume, green bars on high volume. We are ignoring the color of the volume bar. We are only focusing on the color of the price bar. So if you want to do the counting, you can do the counting, but just by looking at the base, I can confidently say that out of 50, 25 are in our favor. Okay, 25 bars are in our favor. What is a favorable bar? Well, red bar, low volume, green bar, high volume. Very, very simple. Okay. So I will not spend time counting that. Now we can do it visually. Okay. We've done so much practice now. Okay. You should be able to do it. Shakeout of obviously there is a shakeout. This low has been taken out by this candle. And remember what I told you in the previous video. Shakeout candle is generally a low volume candle. Why? Because the institutions are trying to kick out those retail traders who have put their stop loss there. So they don't have to sell all their shares. They just have to sell enough amount of shares to push the price down. Base height, I'm sure it has to be C. See, it's 29%. So that's a C grade base. Green zone closing, there is no green zone closing. Okay, that's a negative point. Less than 5% distance to buy point, obviously. 2.74%. Upward sloping moving averages, no. These two are upward sloping. This is not upward sloping. So this will write no. That's a negative point. But it's not mandatory. It's not non-negotiable. As long as the price is above all the three moving averages, we are fine. Then wave heights. So this is 30%. We already know 29%. What about, see, from here to here? So wave heights means point number 1 and 2. What's the distance? 30%. From 3 and 4, what's the distance? From 3, somewhere here, 3 and 4, what's the distance? 6%. So 36, and from 5 to 6, what's the distance? 4. Okay, so 36 and 4, roughly. 30 by 6 by 4. In Mark Minervini's book, this should be 30, then the next wave should be 15, then the next wave should be 7.5. So it should keep on halving. Okay, it should be half after every subsequent correction. Okay, that is not the case here. So this is an irregular base. It's not a proper consolidation. Okay, so a lot of negatives in this base. Let's count the negatives. Wave height is a negative. Upward sloping moving averages, that is a problem. Green zone closing is a problem. Grade base height is a problem. So 4 not in our favor. Then 7 closing price blue zone not in our favor. Rest everything is fine. Okay. So 1, 2, 3, 4, 5. So out of 15, 5 are not in our favor, 10 are in our favor. Okay, which means there is risk. How do you control risk? Two ways. Go in with a small position size, go in with a tight stop loss. So let's say your normal position size is 10%. So instead of buying 10% here, you would buy 5%, half position size. Instead of keeping stop loss here, you would keep the stop loss to maybe point number 6. Okay. So by reducing your position size by half while buying itself, you're cutting the risk by 50%. And then by moving the stop loss from 8% to 4%, you're further reducing the risk by another 50%. So your original risk, let's say your original risk was 100. Now your risk is 25 because you reduced your risk by 75%. That's the mathematics that I want you to understand. If you don't understand that mathematics, you will not be able to take this risky trade. This is a risky trade. Okay. There's no candle close in the green zone. Okay. So you have to understand the mathematics of position size risk management. Okay. Not only have you gone in with a reduced position size, you have also moved the stop loss up so that even if it hits, your actual booked loss is 25% of what you planned to book if you had taken a normal position size with a 8% stop loss. I hope you understood what I said. So rewind and listen to that again. Okay. So that's the base quality analysis for you. This is step number 1, technical analysis. What else will you check in technical analysis? Two things. Is the relative strength line near the 52-week high? Is there a blue dot inside the base? And then you will check the base count, whether this is early stage, late stage, or middle stage. Okay, those are the two things. Plus this becomes your technical analysis. If the stock passes this test, okay, which I think it is, I mean, it's decent. You see a good tight price action on the right side. So even the non-negotiable criteria are in our favor. So this passes the test, although we know that there is risk in this. That's technical analysis. Then what will you do? Step 2, liquidity analysis, comparative analysis, fundamental analysis. That will tell you whether it's a swing trade or a positional trade. Then you will decide whether you want to buy the stock or not and what position size. For that, what you will do, you will check market condition. You will check whether the market is confirmed uptrend under pressure, rally attempt, or confirmed downtrend. Then what you will do, you will execute the trade. Okay, let's move forward. Fantastic. Trading view is working. So high volume breakout has happened. The actual volume is like 200, 300% above the average daily volume. Let's see whether it reaches the target. See, in one candle, it reaches the target. I remember I bought this stock. On this day, I had bought this stock. So it reaches the target in couple of days. This is the fastest of all the breakout examples that we have discussed. This is the fastest that a stock has reached its target. The moment you have to put an alert here, okay, at this level, the moment it hits your selling range, either you sell all the shares. If it's a swing trade, obviously you would end up selling all the shares. You wouldn't want to take the risk because if you wait here, probably the stock might start coming down. Okay, so you want to ensure that you book the entire thing. If it's a positional, you might want to lighten up on your position size depending on how great the fundamentals of the company are. Okay, and you see it continues to move forward. So you have ample time. These are daily candles. You have ample time to sell the stock. Okay, in that selling zone. You see at that range, it again begins to form a base. So a nice breakout always, it forms, it begins to form a base from a proper buy point after it goes up like approximately 20-25%. Well, there are stocks which I have seen which break out and go up 80% without even forming a base, next base. I'm talking about GRSC, Garden Reach Shipping, which recently broke out. Not very recently, but 2024 breakout. Maybe I will look at that example someday. But no way it has come near the stop loss. Very, very powerful breakout. So remember the wave heights. See, this base was not a high quality base. Okay. Still the stock has broken out. So the point is, as what we learned from Mark Douglas, you do your analysis, but you have to take the trade. Okay. The only question is position size. The position size is dependent on market conditions and the risk inside the base. Risk inside the base is uh, understood based on your base quality analysis. Plus, fundamentals also, fundamental factors also play a role when it comes to assessment of risk. So you are not a trader, you are really a risk manager. In technical analysis, you found 5 flaws. Maybe in fundamental, you find another 4 flaws. Maybe in market condition, you see that the market is weak. When all of these risk factors begin to pile up, the more the risk factors pile up, the lesser will be your position size. And the lesser the number of risk factors, the more closer to normal will be your position size. As simple as that. Take care.